today's Targets in Focus, I'm joined by one of DukascopyTV's regular voices, Chief Currency Strategist Camilla Sutton from Scotia Capital in Toronto. Camilla, let's start by discussing one of the euro crosses. What are your views on euro CAD and what kind of movement are you expecting from this pair over the next 12 months?
Well, it's interesting. I think that as we look out on the horizon for euro CAD, it's a slow trend lower, closing the year at substantially lower levels than we're at today. So our year-end forecast is for 123 in euro CAD, essentially expecting most of that move to come from euro. So a move lower in euro overall against the US dollar, but most of its crosses really does weigh on the euro CAD cross, whereas the outlook for Canada is on a relative basis fairly strong. It's certainly been stronger in the past, but when we look at it on a relative basis, it's still very reasonable. Global growth is ongoing. We have oil prices that are above $100. That's positive for Canada. We have interest rates in Canada on hold, but likely to move higher well before most, including the ECB. As well, in terms of the fundamental side of the story for Canada, it has been more positive in the past, but on a relative basis, it's still fairly strong, having recovered all of the jobs lost during the recession, and growth looking to outperform Europe both this year and next year. So for us, that paints a story where euro CAD should trend lower, closing this year at about 123.
If we turn our attention to other high-yielding currencies like the Australian dollar and New Zealand dollar, what are your short, mid and long-term projections for the Aussie dollar, New Zealand dollar and why?
That cross has been in a bit of a fairly tight range, really, ever since mid-November. And I think it's really more of the same to come in terms of how we look at that particular cross. It's really the Aussie side that begs most of our attention, in the sense that the outlook for China, obviously, of the utmost importance, and Aussie being a high-yielding and played very aggressively in carry trades. It's been a very good start to the year. However, I think for the cross itself, it's likely a bit more of the same. So we have a year-end forecast of 131, which is well within that range we've been in ever since November, that kind of 132.5 all the way down to 128 range. So for us, it's the least exciting of some of the more exciting crosses.
The cable's been attempting to break the 160 resistance level. I understand at Scotia Capital you're expecting the pair to hold above its key support at the 156 level and perhaps break higher again towards the year's end and into next year.
Yeah, I think when we look at the longer term, it's certainly a decent story for sterling. I think that all in all, on a relative basis, even though some of the fundamentals are quite bleak in the sense that they have high unemployment, high inflation, on top of it they have very loose central bank policy and strict austerity. A lot of those issues are somewhat negative for the currency, but I think what really benefits sterling when we get into year-end is that it is AAA rated. It does have a credible fiscal plan in place. It does have a developed bond market. So I think the flow side of the story of it being an inter-European play is an important piece. But in the very near term, I think much depends on euro. So if we see euro trend a little bit lower here in the very near term, we could break through that support level of 156.70, which is the 50-day moving average, and move back in, down to 154. But I think that would prove a temporary move, and that all in all, the outlook for sterling is still one where we see it moving higher, closing the year at about 163.
Thank you very much, Camilla, for sharing some of your latest projections for the FX market. Now, there's always plenty to keep you informed on DukascopyTV, so make sure you stay tuned. Goodbye for now.